And yeah, we're super excited to be here to share with you guys. Like Amy said, we specialize in working with real estate investors on how to use how to use real estate to save on taxes. And like most of you, we are not just CPAs, but we are real estate investors ourselves. So one of our passions is in educating people on the fact that you can control how much taxes you pay, especially when real estate is your wealth building vehicle.
Yeah, and as Amy mentioned, our firm Keystone CPA, we do work with investors all over the country, specifically on real estate. It kind of runs the gamut from people just getting started to full-blown investors and everywhere in between. So we're excited to be here. We love talking about taxes, obviously, because we're nerds, but we also love educating people. And so that's kind of why we love to be here, give you guys some good insight today, and take away some nuggets.
Yeah, and our clients do all sorts of real estate, from just a doctor who's starting to buy rental properties, to people doing fix and flips, wholesale, all the way up to people who syndicate very large commercial real estate deals. And what I love about the RPM community and what Amy and Sean teach is the concept of raising money is really important regardless of what you do in real estate. For all of our clients, I was chatting with Amy yesterday, for all of our clients we talk to on the tax side, I always tell people the one skill set you need if you're serious about scaling real estate is to learn how to raise money. So you guys are definitely in the right place in terms of getting that really special skill set.
And I think a lot of the stuff we're going to talk about today too, you can approach it from the perspective of you're the investor, you're the one doing real estate. But also, if you are raising money, always a good idea to be able to speak intelligently with your potential investors or people you're borrowing money from. Help educate them too, right? Because you're going to stand out from your competition. So I think that's a good way to kind of look at it as well.
Yeah, so you're learning for yourself, and then you're also learning on how to talk to your investors, because your investors are generally people with high income and or high net worth. And guess what those people care about? Saving taxes, right? So
one of our favorite quotes is from a old judge, Justice Learned Hand, and he had said in America there's two tax systems, one for the informed and one for the uninformed, and both are actually legal. So let that sink in, right? So we're one for the informed, one for the uninformed. But we want you guys to be the informed group of people, right? Obviously. And so it's really, really important because we're going to talk about some of the different educational things. I think you guys are going to come away with some good stuff. So
yeah, and if you think about it, taxes are actually our biggest expense, right? In fact, taxes are everywhere. When you make money, you pay income tax. We are in California, just a little bit down the road here. And so for those of you in California or any other states, we have clients in all over the US. So Hawaii, New York, you also pay state income taxes. Whenever you spend money, you pay sales tax. When you're driving your car, there's gasoline tax, right? If you go to work and you have a job, you also pay payroll taxes that they take out before you even see any of it.
Think of it, somebody's put some numbers to it, right? Somebody's making $500,000. So before tax, they're making $500,000. After tax, they are losing over 60% of their money to taxes. It's a lot, right? I mean, I think we all kind of know that in our heads, but when you think about the actual numbers of it.
And not everybody makes $500,000. So what we found was the Journal of Economics actually just released their study based on a month ago, I believe, in 2025, that if you're someone who makes about $350,000 per year on average, over your lifetime, you lose about $5 million to taxes. Okay, so again, not everyone here makes $500,000, but a lot of people make $350,000, right, or as a family, collectively. And so $5 million is what we lose to taxes every year. But what if we could save even half of that or a third of that? That would be money for us to invest and build our wealth, right? So that's why we're here. For those of you who are Robert Kiyosaki fans or read his book, Rich Dad, Poor Dad, what he talks about a lot is it's not about how much money you make, it's about how much of it you actually get to keep. So that's what we're here to talk about today, is keeping our money. But I do want to share that, I think the fact that the tax code favors real estate is not a surprise, right? We all know that. We've all heard that before. But most people we meet are still overpaying in taxes. And the reason we believe that to be true is most people have this thought that tax savings are for them, but not for us. Them are the super wealthy. Them are the large corporations. And the reason we feel that way is because we're sort of taught that from a young age, right? Our parents might have complained about paying taxes. When you hang out with your friends, everybody kind of, bitch and moan about how much taxes they pay. And maybe your CPA tells you there's not much you can do to save on taxes. So it's kind of a natural thing when we meet people. They say, I just pay a lot of taxes, sort of, it is what it is.
And not even just those people, too. Think about the media, right? The media talks about it all the time. They want to kind of pitch it in a way hey, this is only available for the uber wealthy. So New York Times actually came out with an article a couple years ago talking about these three gentlemen and phrasing the article like they are able to take advantage of all these things that you guys can't take advantage of. But again, being the super nerds that we are, we wanted to read this article and dig into it, right? And so when we started reading about it, a lot of things they're talking about in the article are the exact same things that you guys can take advantage of. Now, granted, they may have a lot more zeros at the end of their numbers than we do, but the stuff that they talk about, the strategies, they're building businesses up from ground up, not having to pay taxes. You guys buy real estate, it appreciates in value while you're holding on to it. We don't have to pay taxes on that appreciation, right? They are borrowing money against their businesses.
Without paying taxes.
Without paying taxes. We do that with real estate, right? Cash out refis all day long. We use that cash out refi to continue to build our wealth. We don't pay taxes when we borrow that money because it's a loan, right?
Yeah. The article talked about how unfair it was for these people to not only not pay taxes by tapping into the equity in their businesses, but also writing off the interest on the money they just borrowed. Don't we do that all day long, guys? Right? When we borrow money from investors, from banks, we don't pay taxes on that money. When we use that money to invest, whether it's to develop, build, hold short-term, long-term rentals, we also write off the interest. So again, not super secret, not super unfair, not reserved for the wealthy. It's things that we use all the time. The article talked about how these people have plans in place where when they eventually pass away, their family doesn't have to pay taxes on all of the business that they built up. Well, guess what? That rule applies to all of you guys here too. If you bought a property for $100,000 and it's worth $1 million by the time you pass away, guess what? Your kids, your grandkids, your beneficiaries, they inherit that property at that $1 million valuation when you pass away. Nobody pays taxes on all that appreciation. Nobody pays taxes on the depreciation recapture. So, when people tell you, hey, tax savings are only for the super wealthy, now you know better. These are just common things we use all the time as a real estate investor. But like Matt said, maybe we have fewer zeros than these three people that we see on the screen.
So again, it's not just for the uber wealthy. I don't know how many of you guys recognize some of these people on the screen. These are some of the bigger thought provokers, influencers in the real estate industry. And we show this as just a kind of a way to, these people all use real estate to save on taxes. And we know this because we've worked with these people as our clients at some time or another over the past 5-10 years.
Yeah, so you might hear them on YouTube or social media or on different stages talking about how much money they make and how little taxes they pay. And we're here to let you know that's absolutely correct in using real estate. But I know for a lot of you probably, or a lot of us, we can't really relate to the people who we see, on TV or on stage talking about how they save taxes. But just to share with you guys a couple snippets of everyday clients that we work with who pay very little to no taxes. People who, Rick and Deb, who owned real estate for many, many years, but never had a CPA who knew how to pull the different levers to save taxes. Or Spencer, who is a young dad, getting into real estate and really truly understanding how to save on taxes. So just to let you guys know that real estate provides so many opportunities to save on taxes. The only thing that you need to do is to understand how to pull those levers. And guess what? As of July of this year, the One Big Beautiful Bill came out with one of the most massive tax changes in recent history, which has made real estate investing even more beneficial. In fact, how many of you guys heard about 100% bonus depreciation coming back? Okay. Was that somebody yelling about that?
Is that a clap, clap, woo? Is that what we do?
So 100% bonus depreciation effectively more than doubled under what old law was. So we had clients who bought properties, in the spring, where if we were projecting they're going to save $100,000, now they're going to save more than $200,000. And the greatest thing about the depreciation is that, unlike the old law, which sort of started at 100 and kept going down, this time around 100% bonus depreciation is here to stay. So we can expect it not just for this year, but next year and the year after and the year after, maybe until a change in Washington, D.C. Who knows?
But the great thing about the One Big Beautiful Bill is that there's lots of nuggets in there, lots of goodies for everybody. There's things in there for individuals. There's things in there for business owners, real estate investors. I mean, obviously, bonus depreciation was our favorite thing as tax planners and tax strategists, right? But there's other things in there. Now, a lot of these things that they do come with income limitations, right? So if you make too much money, historically, maybe I'm not able to take advantage of this, that, or the other, or that credit. I can't use that credit because I make too much money. But before you tune out, I think we're going to go through we're going to show you a strategy later where we call it strategy stacking, where you take advantage of multiple things. And it's a good way to look at how do I bring my income down from $600,000 to maybe $300,000. Now we can take advantage of some of these things that weren't available to us before.
Yeah, the One Big Beautiful Bill, like Matt said, came with goodies for almost everyone, which is unique. Typically when we see tax changes, it will be something designed towards corporations or designed to bring back U.S. money from foreign countries. But One Big Beautiful Bill, if you're a homeowner, for example, how many of you guys are homeowners? I think a lot of you. So as homeowners, before we can only write off up to $10,000 on primary home property taxes and state income taxes. So those of you in high taxing states, California, New York, Hawaii, you lost out on a lot of deductions. Under the One Big Beautiful Bill, now the benefit is 4 times as much. So starting in 2025, you can write off up to $40,000 on primary home property tax as well as state income tax. Probably doesn't apply to a lot of you, but for the first time ever, we now have tax-free tip income. For a lot of you who work overtime, if you still have a job, tax-free overtime as well, up to $25,000. But like Matt said, a lot of people tend to tune out because there's income limitations. So if you make over $300,000, if you make over $500,000, now you no longer get the tax benefits. But here's where real estate can come in, because we can use real estate to reduce our overall taxable income, and then in turn start to qualify for some of these primary home benefits, child tax credit, and all the different things. Right?
I think worth mentioning too is a couple of things that got extended because of the One Big Beautiful Bill. So not brand new, but really cool that they kept it going. One of them is the qualified business income deduction. I don't know how many of you guys have heard of that. It came out a few years ago, but basically it allows you to take up to 20% of certain types of income to be tax-free. So what kind of income? Realtor, fix and flip, wholesale, CPA business in the right situation, doctors in the right situations, lawyers. But basically, example, you make $100,000 in your business, you only have to pay tax on $80,000 of that income. So that's a cool thing they extended. And then the other one is called the pass-through entity tax break. As Amanda mentioned, there's a limitation on taking state income taxes and property taxes. Right now it was at 10, now it's at 40. That's better. But there's still a limitation. Obviously, we live in California. We can get $40,000 in state income tax without even including property taxes, right? So we lose out on ours. But with the pass-through entity tax break, it allows businesses, S-corps, partnerships that are profitable to pay the state income taxes that you would owe on your share of the profit. The company pays it for you, and it gets a deduction at the company level, avoiding that limitation of $40,000. So this can be a huge federal tax benefit for you guys. So if you're not taking advantage of it, definitely something to talk to your tax person about, because believe it or not, we still see this every day. It's been around for 5-6 years. When we work with new clients who act like S-corps partnerships, we see this missed all the time.
Mm-hmm. How do you know if you're missing it? So if this is somebody who owns a business, an entity, right? And it could also include rental properties too. Rental, property management, development, fix and flip, syndicator. So if you have an entity, then the question is your entity paying your state income taxes for you? Are you paying for that through your entity? If so, that could mean you are utilizing the strategy. If not, and you're continuing to pay personally for your state income tax, then that may be an opportunity you can talk to your CPA about to see if that's being missed, okay?
Yeah, now I think a lot of think a lot, when we talk to investors all the time, one of the common misconceptions is that when you're working with your tax preparer, well, they must be doing tax planning for you, right? Because they know my numbers, they're working with me, they're obviously going to give me strategies. But at the end of the day, it's not uncommon that your accountant is not working with this thing. I'm going to push it. We're going to get to the last slide. Watch this in a second.
So, yeah, I mean, the thing is, we all file tax returns, right? Everybody who earns money is filing tax returns every single year. But what we find is that most people aren't doing the one thing that could actually help them save taxes, and that is tax planning. Okay? And tax planning is when you actually meet with your CPA during the year, before you buy a property, before you borrow money, before you partner with someone else, before you sell your property, where you then strategize on what is the best way for me to do this so that I can do it in the most tax-efficient manner. When we meet people, most folks don't do tax planning. And in fact, how many of you guys can't really find your CPA after taxes are filed, right? Like, where are they? I emailed them, I called them, they don't call me back. Or maybe you're someone who's been on, learning, reading a book about taxes or watching YouTube videos to learn about it, and then you're very excited about all the different ways you can save taxes, but to take it to your CPA only for them to tell you 101 reasons why you can't do any of it. Can't claim a home office because you'll be audited. Can't benefit from real estate because you make too much money. Can't take write-offs because you don't have an LLC, right? So the one key is people always say, hey, what else can I do? How can I save on taxes? Well, you can do tax planning. And it's as easy as sitting down with your CPA, telling them what it is that you plan to do for the rest of this year, for next year, what are your goals in real estate investing, so they can help you with those strategies.
So I think what we're going to do is do a real quick pop quiz. Make sure everyone's still awake before lunchtime.
Yes. So when we meet with clients all over the U.S., one of the first steps in tax planning for us, and every CPA does it differently, but one of the first steps we do is we review the previous year's tax return, business, personal, real estate. And the reason we do that is it tells us a lot about a specific person. We're looking for opportunities for refunds. We're also looking for exposures, right? What might have they done incorrectly? And so the pop quiz question is, what percentage of tax returns we review do you feel are not optimized for tax savings?
So what we're going to do, we're going to do this like kindergarten. We're going to ask you guys to raise your hands quietly, and then if we like you, we'll call on you. And if you get the right answer, we'll give you a copy of our book one of the books we wrote. So our choices are 5, 15, 20%, or 40%. So 40%.
Good job. Here.
Good guess. Good guess.
So pretty shocking, right? About 40% of tax returns we review are not optimized for tax savings. And so for the remainder of our time today on stage, we're going to share with you guys what are some of those common mistakes we see, and then in hopes that you don't fall victim to these same mistakes.
So first one overall is just missed tax deductions. I mean, we see this time and time again for various reasons, right? They don't know what they can deduct. They don't have good finances. They don't have their financial statements on order. I know that's none of you guys in this room, obviously, right? But everybody here is organized. But real estate investors, we're really good. When we're talking about rental properties, real estate investors are very good at capturing the stuff tied to the properties, right? Mortgage interest, insurance, property taxes. Most people don't forget about those. But it's kind of those overhead costs of running a business, right? Travel costs. We were at Bigger Pockets Convention a couple weeks ago. Obviously, going to the event, flights, meals ready at the event, the conference ticket, that's all should be tax deductible. I'm sure you guys paid $100,000 to be here today, right? That should be tax deductible to you guys.
Yes.
If you didn't, that's what they should be charging you guys for all this.
And this is true regardless of whether you have a legal entity or not. And it's true regardless of whether you even owned your first rental or not. Okay, if you don't own a rental yet, this is first step for you is money raising, then these expenses you can actually carry forward into future year, let's say 2026, when you have your first deal, and you can still write off your expenses from this year. So there's a benefit, we're just delaying it by 1 year.
Home office. If you guys are working with a tax person that is still telling you that a home office is a red flag, then you need to fire that person. Home office deduction has been around for 20 plus years. The IRS actually made it easier a couple years ago to take the home office. Most real estate investors we know don't rent office space to manage their rental portfolio. They have a space at home that they are running their business from. So again, home office is a way to kind of convert some expenses on your property that you don't get to usually deduct. Now it turns into legitimate business deductions. So again, if you have that dedicated space, don't be afraid to take that deduction. You need to take the deductions that you're legally entitled to take.
Car expense is another big one. If you use your car for business purposes, then you can deduct the business use percentage of that car. So if my car is used 60% for business, 40% for personal, I can write off 60% of my car-related expenses. This is true regardless of whether your car is owned by an entity or in your personal name. Okay, IRS does not require that your car holds title to your LLC hold title to the car. What they're looking at is business use of it. And business use, I think investors are often confused. Like business use is not only when you drive to a property, for those of you who have out-of-state properties or properties that are far from you, obviously driving to your properties are business miles, but also in addition, anything else you do for real estate, driving here. If you're someone local, you drove here, those are business miles. If you are driving to meet with your CPA or your attorney or your lender to Home Depot, all those are business miles as well. So making sure you track those and deducting them because they could add up. And cars are also eligible for bonus depreciation, right? Similar to rental real estate. So depending on how you use your car, what kind of car you're using for your business, we have a lot of clients that write off a very significant amount on their taxes simply by maximizing their car deduction. And this is very important for year end, right? Because between now and the end of the year, if you're someone who owes a lot of taxes, you could be looking at what are some of the ways I can maximize my write-offs, whether it's for my home office, for, I'm definitely going to a conference next year. Maybe I want to book my flights and my hotels and buy my conference tickets before year end, so that I can write it off against 2025 taxes.
How many of you guys have kids? Awesome. So another strategy, obviously, look at hiring your kids in your business. We call this Operation Zero, right? We hire our kids in our business. We pay them money to work in our business. We take a tax deduction for it. Most individuals can now make up to $13,000, $14,000 a year of income and not have to pay any income taxes. So we all know kids are expensive, right? So let's get them to help you in their business, give them the money. Now they can use that money to go out with their friends or do whatever. But a better alternative to that actually would have them put the money in a Roth IRA. This is what we love. Like if you got a 15-year-old can put $7,000 into a Roth IRA, do that for the next 20, 30 years. I mean, you're changing your family legacy by the time they get to retirement age, right? All that tax-free income that can grow because they started putting money, started that consistency, that habit of putting their first $7,000 of income into a Roth IRA when they're a teenager. I mean, that's pretty powerful.
Mm-hmm. And I just want to bring up again for year end, right? Because we're in November. In November is one of the busiest times for Matt and I in our firm and our team because this is when we're doing year end tax planning for all of our clients. Income shifting is a very important one for year end because if your kids work for you in your real estate business, you need to pay them before the end of the year to take a tax deduction. We always have people who say, hey, I heard you on stage last year talking about pay your kids. Can I do that for last year and write it off? And the answer is no. You have to pay them in this year. Money has to be moved. Work has to be done. You're going to issue them either a W-2 or a 1099, right, depending on what they're doing for you, to document all of those before the end of the year. But yeah, very significant, right? Up to $15,000 roughly per child. That could be $30,000 if you have 2 kids on money you were giving them anyways. But now we're turning it into a business write-off. And when we talk about...
So I was going to say, it doesn't have to be kids, right? Some of you, those of you who didn't raise your hands, I mean, if you've got parents that you're supporting financially, grandkids, have them help you in your business. Mm-hmm. If you don't have kids, you can pay our kids. That's fine too. I mean, it works the same.
Yeah, we got a 7 and a 14-year-old. You know, they're ready to make some money too. But yeah, I mean, so when we talk about missed deductions, it's just really CPAs not being strategic, right? About how to help you identify the things that you can write off. So for all of our clients, we have a 100 plus tax deductions checklist where they can reference and see like, hey, what are some of the things that might apply to me? I don't have a copy of that with me today, but if you guys want, you can find me on Instagram as Amanda Han CPA, that's H-A-N, and then DM me the word 100, and I'll be sure to send that over to you guys. But the key is when you work with your CPA, you are trying to write something off. Instead of just asking them, can I write this off? You can ask them, how can I write this off? So for kids, can I write off my kids? No. How can I write off my kids? Well, maybe you can hire them in your business, right? Puts them in a more creative mode.
I think another mistake we see in terms of overall tax planning is just the wrong legal entities. Now, I'm going to say that accountants might be partially to blame for this, but we'll primarily blame the attorneys, okay? So if any of you guys are attorneys in the room, I'll pick on you. But the misconception is, the takeaway I want you guys to have is that you do not have to have a legal entity to take tax deductions. So if you hear someone say, hey, you have to go create your LLC by year end to take tax deductions, that's the farthest thing from the truth. You need to have a business. So being a realtor, investing in real estate, lending money, those are all businesses. And so now you can take tax deductions without a legal entity. Now you may want to have a legal entity, so rental properties, we like having legal entities for asset protection reasons, but purely from a tax perspective with rental properties, we definitely do not have to have a legal entity to take tax deductions. Another example of kind of missed opportunities in the tax world is if you've got active income. We had a social media influencer a couple years ago making $400,000 a year. When they came to us, they were doing it in their personal name, Schedule C on their 1040, right? So they're paying income taxes, obviously, but they're also paying self-employment taxes. So we were able to show them, let's create an S corporation, put your business in an S corporation, and for them that saved them about $7,000 to $9,000 in self-employment taxes every year, just by that little tweak.
The one mistake I just want to make sure I cover, legal entity, the type of entity, how many properties should I hold, where should I form it? The answer to that is very specific to each investor. But from a high level, for tax purposes, rentals, I don't care if it's long-term, short-term, mid-term, apartment, multifamily, condos, they should be in LLCs or partnerships, okay, not in corporations. S Corp, C Corp are not good for rental real estate or anything that appreciates in value, but for business income, active income, flipping, wholesaling, general, your GP in a fund, those are the ones that we may want in a corporation because of the example Matt just gave, where we can save on some self-employment taxes.
Obviously, when we talk about real estate, we can't talk about real estate without mentioning depreciation. This is Congress, IRS's gift to us as rental property owners, right? We get to make money, cash flow in our pocket, but because we get to take this paper write-off every year in a return, the goal is that hopefully we're not paying any taxes on that cash flow. And sometimes we can actually get more depreciation in our cash flow, and then sometimes there's opportunities to use that loss to save on taxes as well. But I think the mistakes we see with depreciation is that people are not optimizing it. They maybe just take the standard, let's depreciate our property over 27.5 years or 39 years. But with depreciation, there's ways to speed it up. There's ways to slow it down. There's ways to catch it up if you haven't done it correctly over the years. So there's lots of different ways. And again, remember with depreciation, right? We buy a $500,000 property, we put $100,000 down. Our depreciation calculation starts at the $500,000, right? It's not based on our down payment, it's based on our purchase price. So leverage benefits the investor in this situation for sure.
Yeah, if I had $500,000 down, I could buy a building for $500,000, and then maybe my depreciation will be $150,000 under the current law of 100% bonus, or I can use leverage, right? $500,000 down on $2 million worth of real estate. Now my first year depreciation is over $600,000. Right, same amount of money out of pocket. We often have clients ask us like, hey, I'm trying to get this deal. Should I get a partner that's an equity partner, or should I get a lender? And generally speaking, we recommend or we encourage our clients to work with lenders. Why? Because when I'm borrowing money from other people, I keep 100% of the depreciation. I'm the owner of the property, right? They're just a lender to me. Versus if I bring in an equity partner, now we have to share in the depreciation. Same for appreciation. And this is why, when you talk about raising money, how to structure deals, tax is often a very important aspect of what is the right structure, right?
Speaking of mistakes, other things that come to mind with respect to rental real estate is just not being able to or understanding how you can use the tax benefits properly. So obviously a lot of times, I guess, good question. How many have you been told that you make too much money in real estate to benefit from real estate losses? Nobody?
Oh, wow.
This would be the first time.
Yeah. So I think the common thing is somebody wants to invest in real estate, and this might be some of your investors that you're talking to, right? You're telling them the benefits of real estate investing, and then they talk to their CPA, and their CPA says, no, you make too much money to benefit from real estate. Those benefits they're talking about is for people who do real estate full-time. And when CPAs say that, what they're really looking at is because you have a full-time job, you make a lot of money, your rental losses are passive losses, and it's not offsetting taxes from your W-2 income today. Okay, so this is something you'll hear a lot for those of you who are raising money from your investor or investor CPAs. But the reality is then I would challenge that, well, if I did use my money to invest in rental real estate and I generated $20,000, $30,000 of cash flow and appreciation in any given year where I paid zero taxes on that, wouldn't we all agree that is taxes saved? Because I made more money without paying any taxes. And in fact, if I have losses that I cannot use, in a future year when I do have income, for example, I sold a property for a gain, all those losses are freed up. And they can offset all types of income, even my W-2 income. And this is true for everyone, regardless of whether you're full-time, part-time, active, or passive in rental real estate.
Yeah, now obviously, take it a step forward. Like, if we've got losses on our rental properties, is there a way that we can use those losses sooner than waiting until we sell the property down the road? Now, if you are investing in long-term rentals, the general way to utilize that strategy is you or your spouse can qualify as a real estate professional. Now, the benefit of that is if we have losses from a long-term rentals, now we can take those losses and deduct it against our W-2, our active income, our interest dividends, whatever type of income we have on our return. That can be the benefit. So now we're saving taxes now. We can use those tax savings, reinvest it as a down payment for additional properties and continue that wealth building.
Yeah. Or you can use the short-term rental tax loophole, right? Where you could have a full-time job, invest in Airbnbs on the side, and be able to use potentially these depreciation and write-offs against your W-2 income. If the words real estate professional or the short-term rental loophole is something new to you guys, we have a lot of great information about that on our website at KeystoneCPA.com. And we have a couple extra books that we brought here with us today. Again, if those terms are brand new to you, stop by our booth. You know, to the extent we have free books, Anna can give you a copy of it, and you can read up on that. But both of those are super important to real estate investors because they allow you to use rental losses to offset all types of income, including W-2, retirement distributions, if you happen to invest in crypto, all of those things. And that's the world that we want to be in, where we have rentals that are cash flow positive, appreciating, but then we are able to use it to offset the different types of income that we're generating beyond just rental real estate. And so what we wanted to share with you guys is actually a client profile of someone we're working with currently today. Usually when we speak, we share success stories from the past, but because of the One Big Beautiful Bill and the significant change in depreciation going back up to 100%, we decided to share with you guys a story of someone we are currently working on in 2025. So these numbers are projections based on the latest information we have as of now. And the client profile might be something that you guys probably can relate to, or maybe at least know someone or your investors could relate to.
Yeah. Now, obviously, we've changed the names to protect the innocent here, so we'll go with Scott and Darla. Scott is a teacher. Darla's a physician. Between the two of them, they make a little over $600,000 in W-2 income. So obviously, they've been paying a lot of taxes over the years, and it's becoming to a point where it was getting painful to them. And so they have friends who are investing in real estate. They've got friends doing short-term rentals. They've got friends doing long-term rentals. And so they went to their CPA, this is back in April, filed last year's taxes. And when you file the taxes, obviously, they've been historically paying quarterly estimates, right, on top of their W-2 withholdings. So they were getting into real estate. They wanted to invest in short-term rentals, and so they were telling their CPA about this, and he was still giving them quarterly estimates for 2025. Same numbers as last year. And they said, hey, wait a second, We just told you we're investing in rental properties. Where's the tax benefits? And again, it's like, oh, that's not going to benefit you. That benefits them or whoever them is, right? Like, but so they were kind of perplexed because again, we're doing what other people are doing, and we're still going to pay the same amount in quarterly taxes.
So that's when they decided to come talk to us because they felt like maybe their CPA didn't really understand real estate taxes as to why they continue to recommend such high payments. So here are some of the reasons that they were told as to why they don't get any benefits from rental real estate. So first one is you make too much money, right, to get any benefit. And that's what we were talking about earlier. Also, you're not doing real estate full time. So you have to be a real estate professional to get any benefits. But of course, being a teacher and a physician, neither of them were going to quit their jobs and do real estate full time. That was their career, right?
But the key for them too is they were going to invest in short-term rentals. So here's a tip: is that if you're investing in short-term rentals, you don't care about real estate professional status. So for them, one didn't match the other, obviously, and so it was clear to them that their CPA didn't understand real estate. The other thing, car, home office deduction, all that stuff we talked about earlier, that's going to cause an audit. That's what their CPA was telling them. Can't pay your kids, they're too young. Well, they got teenagers. They're not too young. Those teenagers probably know more about social media marketing than we do, right? Like,
or just computers in general,
yeah,
iPhones,
computers in general.
All of the things.
How to work a clicker, I don't know.
Ouch.
Another big thing for them, they were talking about, they've heard their friends talk about cost segregation studies. How do I supercharge my depreciation? Well, their CPA was telling me that's too expensive. That's only for big, huge commercial properties. And so at the end of the day, they were told still to pay $187,000 in taxes.
Yeah. Quarterly estimates.
Quarterly estimates, right?
I mean, you've grown, but that's kind of what they've typically been paying, right? So when we started working together with them, one of the main things we said is, hey, you guys are both going to be working full time. Let's look into short-term rentals because that's what allows you to keep your job without having to quit. Real estate could be a side hustle, and you can utilize real estate to offset all types of income. So let's run through the numbers real quick here. They make over $200,000, $600,000 combined in income. They bought earlier this year in California. They bought 2 short-term rentals up in Big Bear. I think a little over $500,000 each. So pretty small properties up here. I think they're expecting about 28,000. I can't see the numbers.
29,800.
Yeah, of rental income.
Give her my glasses.
All right. So what else did they do? Pay their kids right off home. They did pay their kids a little bit. They had teenage kids who helped them out with setting up their STRs. Nothing crazy, right? They didn't even do the annual max, just a little bit to help out on their first year.
But here's the big ticket. Obviously, we worked with them to get cost segregation studies done. And for them to do a cost segregation, again, with one big beautiful bill, taking advantage of a bonus, 100% bonus depreciation, they're going to get almost $290,000 of depreciation write-offs that they can use this year to offset against their income. So again, their income goes from almost $650,000 down to under $350,000. And that's going to save them over $112,000 in taxes.
And you know what's not included in here, guys, is the fact that now that their income went from over $600,000 to like $300,000, right, adjusted income, now they can utilize that, $40,000 primary home property tax deduction that they would otherwise not have been able to use because their income was too high. Now they can utilize some of her overtime as a physician could be tax-free, whereas before she would not be able to get any of that. They can get some child tax credit for their kids. So you can see this is what we call strategy stacking, where who cares about home office? Who cares about writing off, paying our kids? So when you add it all together, it becomes a very significant tax savings. Obviously not everyone's going to save $112,000 in taxes like these people do. But what if we just save $10,000 in taxes? It's $10,000.
So, quick thing here. You save $10,000. Great. Well, over 10 years, you save $100,000. What's going to happen with real estate in 10 years? If we assume a 7% appreciation, you're going to have real estate worth $740,000. I like our plant in the audience here.
Yes, you're the best. You're coming with me to all of our speaking engagements, please.
Hey, maybe you do better. Maybe you save $20,000. At the end of 10 years, we've got almost $1.5 million. Maybe you can supercharge it and say $50,000. At the end of 10 years, you could have real estate worth $3.7 million. So again, is that cost segregation study that's only available, it's too expensive. Well, if I save $112,000 in taxes, doing better than $50,000, and I can do that every year, which may be obviously a big stretch goal, but you get the idea, right? There's savings to be made here.
Yeah. And so when people talk about how understanding taxes is one of the key elements to wealth building, you can see how the numbers add up, right? Because we're not just saving taxes for 1 year. Once you know the strategies, you're utilizing it year after year. And it's not just the tax savings, but what can we do to grow and invest the taxes that are saved? Right? And so again, the key we want to leave you guys with is that in order to effectively save on taxes, you have to do tax planning. It is not done when you are filing last year's tax returns. And you want to be working with the right CPAs who are actually helping you to strategize. So the question to ask yourself is, does your accountant tell you more about what you cannot do versus what you can do? Because that is the job of a CPA, is to help you strategize what can be done to save on taxes. And I think a lot of you might be wondering, like, gosh, I wonder if I'm overpaying in taxes. Unfortunately, we can't tell you whether you are. You know, the answer is very specific to each person. But what we have is we've created a tax risk assessment. You can scan the QR code here. It'll take you to our self-assessment where you answer a series of questions about your personal, your investing, your retirement accounts, and then what you'll get is a score emailed to you at the end. And you know, if you score high, great. That means you have a lot of the foundational strategies in place with respect to tax savings. If you score low, that's also okay. That just means that there are more opportunities for you to look at, to consider in saving on taxes. And what you can actually do is you can print out the test result and bring it with you. The next time you meet with your CPA, you can say, hey, can we start with this list of things that I've answered no to? And let's start investigating there and see how can we turn some of these no answers into yes answers. So thank you guys so much. We have a booth outside. We'll be around to answer any questions. Thank you to
Give it up for them, guys. Come on.